Oh, we are live. Hello, everybody. Good to see you all. Welcome to the Epic Real Estate Investing Show, where we show people how to invest in real estate so they can escape the daily grind and retire early. And today we're going to talk about the crashing market that everyone is talking about. Headlines keep coming up, and the YouTube notifications come up, and the podcast notifications and new releases coming up. Everyone's talking about the crashing market, and this is the absolute end. So that's what we're going to talk about, and we're going to look at the data, and you get that you can see it in a way where you can make up your own mind. And before we do, I just wanted to share with you that I'm hosting a free training tomorrow night, where my buddy, he put something together that's really, really cool, and it's on how to find deals. It's so cool that it's patent pending, meaning it works, and he wants to corner the market on it, and it appears that he is. So that's tomorrow night. He's going to show you how it works, and here's what's the great thing. He's going to demonstrate live. You can look right over his shoulder, and he's going to reveal in real time 5 deals. And he's going to give you 5 deals, the actual addresses that are live right now, and you can go write offers on them because you already know they're real deals. And so if you'd like to join us, you can go to WednesdayWebClass.com. WednesdayWebClass.com. Oh, see the link right there on the screen, and you will see a link down in the description below for you too. All righty, let's see. Hello, Kevin. Good afternoon from Lakeland, Florida. I said, we did this last time. I almost said Lakewood, California. Lakeland, Florida, because I used to live in Lakewood, California. I was a real estate agent there for a little while. Perfect. So good to see you. And if you got any questions, fire away. I'm going to go over the market right now and what we're seeing, and so that you can make up your mind of what the next best move is for you. But if you have any questions along the way, just go ahead and type them there in the chat, and I will make sure that I get to them before we go. All right. So let me share my screen here. Did a little bit of prep, trying to save you guys some time. I think it's this one right here. Okay. All right. Oops, wrong page. Anyway, if you guys didn't check it out, I just converted or closed a seller finance deal. So the newest video that I put up right here, getting them to say yes to seller financing. So if you've ever struggled talking to sellers, how to get them to actually open up and be receptive to seller financing, there's a live call right there, and I just put that up there last night. Anyway, that's not about today, but it's there if you'd like to check it out. All right, so I'm going to start with we're going to go over the individual markets that are predicted to crash, where everyone's predicting that the price is going to fall. But first, I want to go through just kind of what June's numbers. We're going to get a little snapshot, nationally, and then we'll go regionally, okay, and see if your market's on there. But when we're looking at the market or anything really in our economy, you're always looking to see at supply and demand. We've talked about that a lot here, right? The supply is really, really low. We all know that, and the demand is way, way up, meaning that there's more people than we got houses. Now the interest rates are kind of crushing the demand, but that doesn't crush the need for people that want to have a roof over their head. So always keep that in mind. So if we see some sort of correction, we see some sort of crash, based on the actual demographics, it can't last. We're going to have to put a roof over it. Something will have to change, right? So, back in 2007, 2008, that crash was very much based on speculation. People were buying houses, anticipating them to go up and rise, and everyone just bought too many, and then it crashed because we didn't have enough people to live in those houses. Well, that's completely reversed this time around. So these houses that are being consumed are not necessarily being consumed on speculation. They're being consumed because people need them to live in, whether they're buying them or if they're buying them and renting them out, they still got plenty of renters to live in them. So that's a big difference between now and 2008 crash. But if we look at the active listing count, because this has been the big story, right? The inventory. So listings that are on the market, they kind of go through a seasonal pattern, a seasonal trend. And you can see these top 3 lines. This kind of represents a normal market. So this was 2017, 2018, 2019. You kind of see there's a nice little flow, and basically all 3 of those years were essentially the same. Then this line right here in the middle that's on this decline, this is the decline of 2020, our year of the pandemic, right? So inventory dropped considerably. And a lot of people think it was a pandemic-induced drop, but I don't think it was. I think it was something very different at work. But here we are. This was 2021 was this green line. And here we are in 2022 is this bottom yellow line. So you can see we hit the really bottom of inventory right around February, maybe March. Some people are saying March, but based on this graph right here, we're about February. But now we're rising up, and everyone's talking about this huge surge in inventory, right? So, inventory is just houses are coming on the market, and there's all this inventory, and now that's going to cause the housing bubble to pop. Well, really, right now, all we see is it's just resuming the trend, but still, we're historically low. We're significantly lower than our normal markets in 2017, 18, and 19. So we could essentially come up quite a bit and not really cause any sort of alarm based on a normal housing market. So just kind of keep that in mind. And then July, I don't have that graph with me, but July, it has gone up again. So this yellow line is continuing to rise, but at a slower rate. So we're seeing already this curve right here is happening for July. So then the pending listing count. So pending means properties that are under contract, where people have made their offer, they got their offer accepted, and they're waiting to close. So you can see quite the reversal here. We can see 2017, 18, 19 are these numbers down here at the bottom. So of all these properties here that were for sale, it was a smaller number that were actually under contract. And so as we see here, we're seeing that the housing contracts are being canceled. We're hearing that a lot. And that's kind of where this decline right here is for 2022. But we've got more houses under contract than we did here, but we got it with much less inventory. So the demand is still really strong according to these charts here. Newly listed homes. So newly listed homes are on the rise. So you can see this is up here, and we're approaching kind of a normal level based on the monthly newly listings, but we're already starting to see it edge over. Okay. Then I think there's one more here. This was interesting. So we're thinking that the market is slowing down and it's about to pop. But here's our average days on market, how long it takes for a house to actually sell from the time they put it on the market to the time that it goes into contract. Okay. Does it go into contract, or does it go in when it actually closes? Let's see. I think it's when it closes. It doesn't matter. Whether it's 30 days longer or 30 days shorter, it's not going to matter as far as the point I'm making here. But we can see houses are still on the market for only 30 days and they're gone. So although the sales activity may be slowing, still historically low days on market. So the market is really still robust. Okay? So I wanted to show you that to kind of give you a glimpse of what's actually happening. Then the median list price. This is kind of normal because this is going to get higher each year as appreciation happens. So this is the listing price. And so let's talk about that. So if we go over here to home prices, where are they actually going predicted to fall? We've seen what they've been doing. That's not really news. We see that rising. But it's good to get this like a big picture view, because if we hear like, hey, the inventory surged 18%, but that sounds crazy, but it's 18% of what? It's 18% of a really low number. So we want to keep all of this stuff into perspective. So home prices have begun falling. Here are the cities where they're down the most. And one thing that this article points out, this is from Realtor.com, this is not a repeat of the Great Recession when a housing bubble popped and prices plummeted across the country. These are mostly smaller decreases that don't portend another crash. So if you restart reading these articles and you get into the nitty gritty, you start seeing that, oh, the data is not that bad. Like they try to lure you in with the headlines, and then you start reading a little bit deeper and it tells a little bit of a different story. But here are the 10 markets where they say where home prices are falling the most. Now, it's key to have the distinction of where home prices are falling the most. Which price? It's not the sales price that's falling. It's the listing price that's falling. So what that means is, a seller thinks, oh, the guy next to me, his house sold for $500,000, then I'm going to put mine on the market for $550,000. And then nobody comes to look at his house now, like in the current market. So he has to lower it to $540,000, $530,000, $520,000, and then he sells it for $510,000. So he might have had a significant or a big number of price reductions, but he still sold it for more than his neighbor did. So keep that distinction. There's what the seller's expectations are, and there's what the buyers are actually validating as far as price goes. So we've got Toledo, Rochester, New York, Detroit, Pittsburgh, Springfield, Tulsa, Los Angeles, Memphis, Chicago, and Richmond, Virginia. So are where sellers are becoming more realistic and dropping prices. Okay, so Toledo, and you can see right here, median listing price. The listing price, not the sales price. So in Toledo, they dropped at 18.7%. Rochester, New York, they dropped at 17. Detroit, 15. Pittsburgh, they've dropped at 13%. So these are very ambitious sellers in these markets, and now they're becoming coming to grips with reality. Springfield, Massachusetts, negative 5.8%. Tulsa, Oklahoma, negative 5%. Los Angeles, down 5%. Memphis, down 4.6%. 3.7%, and Richmond. And this is what I thought was interesting. Of these top 10 markets, once you get to the 10th one, it's only a 3% drop in the listing price. That's a little bit. It's just 3%. Okay. So there's that. There's their version. We've got three other versions. None of us have a crystal ball, so we got to look at a few different resources, right? A different source information. So here, housing prices are expected to drop in these cities. We'll see if yours is right, if this is one of your markets. And they talk about overvalued markets, and it's very that could be a very broad definition. So a housing market is overvalued. It's when it means its home prices are higher than expected compared to average local incomes. Okay, so it's based that it means the people that work there can't afford those houses, but people are still buying them, and we see that in a lot of our luxury areas. I went on a trip last summer to Jackson Hole, Wyoming, with my son, and half the restaurants were closed. And I had asked the guy at the hotel clerk, what how come all the restaurants were closed? I was actually thinking it was the pandemic and people were still kind of reeling over COVID and everything. He says, no, they don't. The service people that work at the restaurants, they can't afford to live there. So you could look at Jackson Hole, Wyoming as an overvalued area, but are people really going to sell? Do you think there's going to be a crash? No, the people that are living there, they can afford it, and they bought it, and they don't plan on moving. That's their dream home. They're staying. And you'll see some of those in these other areas, like Boise, Idaho. That was another big place. So 73% overpriced or overvalued. Sherman, Denison, Texas, Muskegon, Michigan, Morrison, Tennessee. So you can see all of these areas are overvalued, but it just means the housing price compared to the local income. Okay, so let's look at this one here. This is from Fortune. This is a little bit better of a depiction of what's going on, a visual, so to speak. All right, so the headline here is housing markets labeled high risk of home price drop just spiked 73%. Find your local market using this interactive map. So that sounds crazy. The home price drop just spiked. The risk of a home price drop just spiked 73%. Oh my God, the sky is falling, right? All right, so if you dig deeper into it, here's what we see. I had this data here. Was it right here? Okay, so CoreLogic, they're a data resource center. They do a lot of research. They predict U.S. home prices are poised to rise another 5.9%. So nationally, they're going to rise still, 5.9%. But not every housing market will be so lucky. Fortune reached out to CoreLogic to see if it would provide us its assessment on the nation's largest regional housing markets. Among the 392 regional housing markets it looked at, CoreLogic found 45 markets had a greater than 50% chance of seeing local home prices decline over the next 12 months. Last month, only 26 markets, that's a 73% jump. So it's just a 73% jump in their predictions, right? So here was there was another piece of data here that was actually much more interesting. A combination of record here's another sheet. Okay, well, we'll keep on going. All right, so if you look at these areas, very high is categorized as over a 70% chance of a price dip. So you want to look at the blue ones. The high, very high is, that'd be the light blue. Oh, wait a minute. No, very high is the red. My bad. Very high is the red. So if you see the red here, that means very likely of a price dip. And if you look at the blue, very low chance. And then in the middle there, the pinks and the light blues. But you can see most of the country is this very, very low or light blue as far as pricing, predicting the price dropping. And then if you go here, it's basically right here along the coast is where you're actually going to see a very high chance. That just says it's a high chance of a price dip. It doesn't say it actually happened. Okay. Next, let's go over to Bloomberg. U.S. new home sales fall more than forecasted two-year low. So purchases dropped 8.1% in June to annualized 597,000 rate. So these are new homes. These are not people deciding to sell their home and putting their existing home on the market. So these are the sales of the new homes. So sales of new U.S. homes fell for the fifth time this year in June to a more than two-year low as a mix of high prices and rising mortgage rates for prospective buyers. Okay, so purchases, they decreased 8.1%, and they continue to slow. There was one piece of data here I wanted to get for you. The new home sales price. I got to get one of those that little software that allows you to highlight it and keep it there. Let's see. But these are new homes. So the new homes, there's 9 months of inventory of homes that are built or are in the process of being built. But the new home builders have actually stopped building new homes. So there's not going to be this flood of new houses hitting the market. Okay. There's the inventory number. There's that. So when you see all that, this was the number. All right. So we see the sales activity dropping, right? The number of sales are decreasing. We're hearing about in the headlines that prices are dropping, but those are the listing prices. If we look at the latest report from, is it here? Right here. Can I click on that? Will it make it bigger? There it is. Okay, cool. So we can see right here. So there's been $5.12 million homes sold. So the month over month, that's a decrease of 5.4%. So the sales activity dropped 5.4%. Year over year, that's a 14.2% drop. That's a big deal. But if you look here, the median sales price is $416,000, is actually up 13%. So yeah, the number of homes being sold is falling, right? It's decreasing. But the actual value or the price of the houses that are being sold is rising. So what does that mean to us as real estate investors? Well, first part, when we look at the inventory, this is how I'm determining it for my own. I look at the inventory and I'm like, okay, we're still really, really low. I can still buy rentals as long as I can get them to cash flow. I'm still going to be fine because the inventory is so low and we're not going to see any new homes hitting the market. And we're already seeing a decline of the new listings, a decline in the rate of growth of new homes hitting the market. So the supply and demand is still very much in favor of an investor. It's still very much in favor long-term for the home buyer, regardless of the interest rates, right? There's more people in, I don't have this data. Hold on, maybe I can get it right here. U.S. population. I love this chart right here. Chart by age, I think is what it's called. But this is so telling right now. If we look at this right here, it's this chart right here. So over here to should be to the right. Just ordered a new computer yesterday, by the way, so there'll be no more of these delays. Here it is. So over here to the right. So you can see this is the growth of the population divided up in, not the growth, but our whole population divided by age in the generation. So here's our millennials, this yellow number here in the middle. And right here at this peak, that's age 32 years old. If we come down 2 little bars down here, this is about 34 years old. And the reason I point that out is the age of the average first-time home buyer is 34 years old. So what that means is over the next 24 months, maybe even 36 months, the housing market is going to see more demand for housing than it's ever seen before in the history of the country. So that is a good condition to keep buying real estate. Because if the first-time home buyers can't afford it, they still need shelter. They're still going to have to live somewhere. So they're going to be renters. And what we're seeing right now is rents are starting to catch up and overtake the growth rate of the actual housing prices. So the demand, we can't deny it, right? The demand, we can't deny it. And the supply, the numbers are right there in black and white. So that's what it means for landlords, investors. What does it mean for fix and flippers? Well, the real estate agents are all reporting right now that they're not seeing the massive amounts of auctions for houses, the overbidding, but they are seeing auctions still for the nicest houses. And it's these nicest houses that are selling, and that's why we've got this price going up right here, up still 13%. So if you're going to be fix and flipping, essentially what that I would translate that to is you got to step up your game. You got to make sure that your house is really, really nice, because now the buyers, they've got a little bit more choice, they got a little bit more selection in the market, and so they are choosing to allocate their money towards those nicer homes and ignoring the rest. So that's where we're seeing the slowing of the sales activity. There's in the houses that might not be in perfect condition. I mean, they might even be B pluses and A minuses, but that might not be good enough right now for this market, as buyers are looking for the A's and the A pluses. So if you're fix and flipping, you got to bring it. No more cutting corners. Otherwise, you might be sitting on the market for a while. I think you'll still be fine long term, but if you've got hard money and you've got those expenses, you might be on there for a second. Okay. All right. So let's see. Linda. So this is a good question. Yeah, she's asking, Linda's asking, if the economy slows and people stop having money to travel, will Airbnb sell or rent their properties? Very good, especially places like Anaheim, California. That's really, I wish I had a crystal ball. None of us really know what's happening. I know there's a big Fed announcement happening tomorrow. Some of the predictions are the rates are going to be hiked up potentially a whole percent, which I don't think we've ever seen. That would be a significant raise. It could probably change the course of the entire economy. So who knows? But if the economy changes, if the housing market changes, if it does crash, it's not going to be due to the housing market. It will be due to monetary supply. It'll be due to interest rates. So keep your eye on that. To me, that's the big variable. That's the thing that we have to watch. And I'd have to imagine if it got too out of hand and they overcorrected, they're going to recorrect really, really quickly, because we are approaching 2020. We're in an election year, right? And the administration currently in charge certainly doesn't want to go into an election cycle where everybody is upset. So I'm kind of thinking about that too. The last couple of years, we've been able to watch how politicians play, how the different sides play, and they all play kind of dirty. But we do all know, we've all come to the realization of what's most important to them is winning an election, right? So if whatever they have to do to get on the good side or the good graces of voters, it looks like they're mostly inclined to do that. So they could, depending on what we see tomorrow, those rates could go up and it could cause panic. But I think it will be short-lived, because if it causes too much panic and too much discontent in the market, they'll have to recorrect right away if they plan on staying in office. Just my thoughts. And that's not a right or left conversation, by the way. I think both sides would do the exact same thing. Okay. Let's see. Peter Schiff. This week would be a great time to lock in purchase rate. I think so. I think you do it today, Peter. Based on what the Fed is going to announce tomorrow, by all indications, it's going to be up there. But they've surprised us in the past before, but I don't think that would be a bad idea. Particularly if it's going to be determined whether or not your investment property is going to cash flow or not. I think that would be an important decision. All righty. So it's been a pleasure, y'all. And we'll do this again. I'll keep you up to date with what I see. But just understand, when you're reading the news, when you're reading the media, the headlines are going to pull you in because they're going to scare you. They're going to shock you. And you're going to start reading it. And once you go ahead and start reading down those lines, you start seeing like, that's not such of a big deal, right? Or that's not so bad. When they say that the prices are dropping, it's the listing prices. It just means sellers are getting more realistic. But the housing prices, the ones that actually sell, is still going up. When they say the market is really cooling off, that just means the growth rate has slowed down, but it's still a growth rate, right? So just kind of understand it and read in between that, because there's always what's factual and then there's what's actual. Fact, yes, the growth rate is cooling down. Actual it's still a growth rate, still up. Okay, so that's it for today, and I will see you next time. If you know anybody else that would like to see this or would benefit from this, when their name comes to mind, please share it with them. And if you'd like to know how to lock up a seller finance deal, go check out the latest video right here on the YouTube channel, most recent one, getting them to say yes to seller financing. And if you'd like to join us for our Wednesday web class, we're giving away 5 deals for free. 5 deals. Come in. You'll look over our shoulder. You'll see how we found it. And then there'll be a live address that you can go write an offer on because you will already know that it was a deal. So Wednesday web class, you can join us there tomorrow. And that will be it. All right, y'all. Signing out, and I will see you next time. Take care.